What's up, legacy builders? I want to talk to you guys about your legacy generation system wealth reserve contract or your wealth reserve account. What is that? Infinite banking is a title that was given to the system or strategy of leveraging this contract where you can overfund the contract up to the MEC limit so that you don't pay any taxes on the growth inside the policy as the money is growing between 5.5 to 6.5% compound interest growth with dividends. It's tax-free growth. Okay. But then you're able to borrow against that equity. So that contract is an asset. And inside of this asset, which is the life insurance contract, it has protections where your liquid cash that's stored inside the contract, which is not going towards purchasing and paying death benefit, but it's sitting in the contract in a space called the paid up edition, where cash value is growing, compounding interest. And with that, it's tax-free growth. Okay. That tax-free growth, think of it as equity growing inside of your contract. Now you're able to take a policy loan against that equity, not from, against, which means that the money doesn't leave your contract. It doesn't leave the asset. It stays inside and it continues to grow uninterrupted while you're getting a policy loan against the equity. So think of, for example, a real estate property, an asset that you own. If you own a real estate property and you've paid into it, over time you have equity. That equity will allow you to then qualify for a home equity line of credit. But to get access to that equity, they're going to run your credit. You have to have good credit. It's going to require an inquiry, and it's going to show up on your credit report as a new account in your credit. The bank dictates to you what's the due date, how much to pay back, when to pay, and if you don't pay on time, you're going to get a late payment and you're going to hurt your credit. When you finance or fund your PUAs inside of your whole life insurance contract and the equity is growing inside of this asset and you borrow against it, there is no credit check requirement. The bank does not tell you when to pay anything back because you're not borrowing from a bank. The lender is issuing you a policy loan against your equity, and you become the bank and you decide when you pay back, how much you pay back on your terms. So you get back control over when and how you pay, and there's no credit check. There's no late payment. There's no late fee because, hey, you decide if you're going to pay a minimum payment or not. So you control that. With that said, I do advise, and I'm going to coach and guide you to treat yourself like a bank and give yourself a minimum monthly payment so that you can start paying back your policy loan and avoid any interest on the policy loan. However, you control that. So therefore, if you have a bad month or a quarter and you can't make your payment, there's no late fee and it's not going to hurt your credit. You're in control. Later on in life, you're able to leverage that and borrow against it for retirement planning. And it could be a strategic play where you might not pay it back and allow the death benefit to solve for the balance, because at the end of the day, your life insurance contract has a death benefit, and this asset that's building equity is protected by the death benefit, which will always be greater than the cash value. So if you unfortunately could not pay back a balance and you passed away, well, the death benefit will solve that balance for you before it gets distributed to the beneficiary. And later on in life, part of a retirement strategy play could be that if needed, you could borrow against the policy and just let the death benefit solve it for you. That's okay. If you don't have an heir or someone that you want to leave that benefit to, you can leverage it strategically in that way. However, in the early years, while you're storing and you're building wealth, you want to start borrowing and paying it back aggressively so you can leverage it again and again, like a true line of credit, but you are the bank. So this policy is giving you a contract that protects your money. The growth is tax-free. You borrow against it tax-free and pay it back tax-free. The death benefit is tax-free. And in most states, your money inside this policy is protected from litigation and creditors. So your policy is protecting your wealth and it's growing tax-free for the rest of your life. At the end of your life, you can then leave that to your beneficiary. Now, who's that beneficiary going to be? It could be anyone you want. What I'm going to recommend as part of your legacy generational system strategy is that you make your trust the owner of your policy. So we're going to set up a trust, whether it's a revocable or an irrevocable trust. And trusts, there's many, many levels of different types of trusts, but on just a basic level, you're going to set up a trust. You're going to make the trust the beneficiary, so the trust receives the death benefit. And inside the trust, you're going to create rules with if-then statements on how that wealth is distributed to the next generation. This is the difference between generational wealth and generational legacy. Unfortunately, the statistics show that generational wealth is squandered by the second generation. 70% is squandered. By the third generation, 90% of generational wealth is squandered. However, if you set up your wealth in your legacy generation system, utilizing your wealth reserve contract, your whole life insurance contract, combining that with a trust, then you're creating generational legacy. And this is something that you can perpetuate indefinitely for infinity, because if every generation that is born is going to be required through the trust to set up a new contract, a new wealth reserve contract, a new whole life insurance contract that's going to have a death benefit, then it's going to replenish the trust generation after generation after generation. And in one lifetime, there's typically 3 generations. There's going to be the newborn child, the parent, and then the grandparent, right? So the grandparent, when that person dies, that wealth, that death benefit goes to the trust. Now the parent of the child has a death benefit. The child has a death benefit. And then as you get older and you become the grandparent, you leave that wealth to the trust when you die, and we continue and perpetuate this legacy forever. This is how we build generational legacy, leveraging a whole life insurance policy with a dividend paying mutual company, high cash value, optimized efficiently for high cash value, and for you to be able to utilize it as your own bank, what they call infinite banking. I call this your wealth reserve account or your wealth reserve contract, which is part of your legacy generation system. Coupled with a trust, you will leave generational legacy. If this video was of value to you, please make sure you like, subscribe, and share. Please look in the description if you'd like to schedule a one-on-one for a legacy clarity call, or if you'd like to schedule to see what an illustration of your wealth reserve contract or account would look like. No obligation or commitment. We can take a look and see if what I'm sharing with you makes sense for your lifestyle and for your business, and ultimately for the legacy you leave behind. Thanks for watching. God bless. Take great care.